What is the difference between VAT and sales tax? Have you ever wondered how taxes work differently in various places? Today, we are going to break down the differences between value-added tax and sales tax. Understanding these two types of taxes is important, especially in the context of capitalism and government regulation. First, let's look at how these taxes are applied. Value-added tax is a multi-stage tax that is charged at each step of the supply chain. This means that from raw materials to manufacturing to the final sale, businesses collect this tax. They also can claim credits for the value-added tax they paid on their purchases. This system ensures that the final consumer ultimately bears the tax burden, but it is collected incrementally throughout the production process. On the other hand, sales tax is a single-stage tax. It is only applied at the final point of sale to the consumer. Businesses do not charge or remit sales tax on their purchases. They only collect it when selling directly to the end consumer. This difference in application stages is a key factor in how these taxes affect businesses and consumers. Next, let's talk about who collects these taxes. Under value-added tax, every business in the supply chain collects the tax on its sales and sends it to the government. They can offset the value-added tax they paid on inputs. In contrast, with sales tax, only the retailer or final seller collects the tax from the consumer and sends it to the government. Geographical prevalence also plays a role in understanding these taxes. Value-added tax is widely used internationally, especially in Europe, Asia, Africa, and South America. It is usually administered at the national level with consistent rates. Sales tax, however, is primarily used in the United States. It is set at the state and local levels, leading to a variety of rates and rules across different jurisdictions. When it comes to tax rates and complexity, value-added tax typically has a few standard rates across a country, which simplifies compliance. In contrast, sales tax rates can vary significantly from state to state and even among counties and cities, creating a complex patchwork of tax rules. Lastly, let's consider the impact on businesses. Value-added tax requires businesses to keep detailed records of the tax paid and collected to claim input tax credits. This can increase administrative work but helps prevent tax cascading, which is when tax is applied on tax. Sales tax compliance focuses on collecting tax only on final sales, but businesses must navigate nexus rules, which determine when they must collect sales tax in different jurisdictions. This can be quite complex in the United States. In the context of capitalism, these differences influence how businesses operate and compete. Value-added tax can encourage transparency and reduce tax evasion, potentially leading to a more level playing field. However, it can also impose administrative burdens, especially on smaller businesses. Sales tax's simpler model reduces complexity but can create uneven competitive conditions due to the fragmented nature of tax jurisdictions. Understanding these distinctions is essential for businesses operating internationally or entering markets with different tax systems. The choice between value-added tax and sales tax impacts pricing, cash flow, and compliance costs, making it a vital topic for anyone involved in business today.